Mukherjea as well joining in on the show. Hi there, good morning, Saurabh. Just a short while ago, Ajay was alluding to the fact that yes, there is potential in the reopen trade, but as of now, he wouldn't be investing or buying into any of the hotel-related stocks. What's your sense as we are seeing things normalize quite significantly, and where would you stand when it comes to multiplex, hotel, retails?
Look, we'd never owned any of these things, and no barriers to entry, right? Last we knew it's not very difficult to open a hotel in our country, and I can't think of a single hotel chain in Indian history where return on capital exceeds cost of capital. I can't think of a hotel chain which generates free cash flow. Similarly, the multiplex chains also struggle to generate free cash flow for very similar reasons. So I'm sure they'll do well. You're right in saying that. As the world normalizes and we go back on holidays and we go out during the weekends, these companies will do well. But buying a company, is a longer term investment. We buy companies that we don't sell over 5 to 10 years. And I can't think of, I'm trying my best, but I can't think of a single multiplex or hotel chain which over the last 5 to 10 years has generated any free cash flow in India.
What about some of these new age listed tech stocks, given what we've seen play out with respect to Paytm, the likes of Policy Bazaar, as well as Nykaa? Where do you stand, Saurabh?
So again, most of them don't make any money, have never made any money. As I've discussed on your channel before, Nykaa seems to be the best of these companies. I think Falguni Nair has built a good franchise. She has built customer captivity, as I can see from my own wife and daughter's shopping habits. So all credit to Falguni and team. They've also built a profitable business. But early days, we need to do far more work on Nykaa to figure out whether it's a investment proposition. But if you ask me, amongst the IPOs of this season, Nykaa seems to be the best managed, the most likely franchise to build a great business over a 5 to 10 year period.
Saurabh, I want to dig up one of the old names wherein you turned very first before anyone in the market could catch it, and Reliance is the stock that I'm talking about. Having said that, finally it's beginning to nudge up and, on some certain days actually lead the market recovery as well. Has the time now come wherein you're going to change your view on Reliance? Maybe that time-wise consolidation is finally over. Do you foresee that?
We look at a lot of credit to them for what they're doing. They're taking a old style conglomerate which was strong in chemicals and refining, and tilting it towards telecom, towards retail, towards the modern economy. I don't think I've seen a transformation of this scale anywhere in the world. It's just that process of basically changing the engines on a jet plane as the jet is in midair. That process is obviously drawn out. It's fraught with risk, and given our conservative style of investing, given Marcellus's conservative style of investing, we've never quite been able to get our heads around that. So it looks as if that transformation continues to progress in a positive direction, tilting Reliance from being an old style chemicals and refining business to a new economy company. But as yet, we haven't seen the free cash flows emerge from that, and hence we are still watching it carefully rather than investing.
What about, the specialty chemical space? Because, Saurabh, that's been a favorite. There's been GMM Pfaudler as well as alkylamines. Is there anything else within this space now that's catching your eye?
So we continue buying more of GMM and alkyl. We've also built a position in a company called Paushak, which is the market leader in phosgene. So phosgene is an essential industrial chemical. It's as essential as, say, chlorine. Because it's a controlled substance, the government doesn't give out licenses to build phosgene factories very often. But the demand for the product is vast, supply is scarce. Paushak is the market leader, and hence in our small cap fund, we have built a position in Paushak.
Hi Saurabh, good to connect with you. Saurabh, are we reaching that typical value zone for the good old favorites of Marcellus, whether it is Asian Paints or Pidilite? I mean, the uptick in crude optically is bad news for next 2 quarters for some of these companies. It could be inventory loss, it could be inventory gain, we don't know. But as an investor, are you using the bad news to buy them?
So we've been buying Asian Paints very enthusiastically over the last couple of months. As you are suggesting, Nikunj, crude is a pass-through for well-run franchises, Asian, Berger, our other holdings. And just a double disclaimer, when I say we've been buying them, we are buying them as Marcellus because my money, my parents' money is also invested in Marcellus. I'm therefore indirectly also buying these stocks for myself. So Asian Paints has been here several times before where crude prices double in the course of a couple of years. Asian Paints passes the margin impact on to customers. So EBITDA margins at around the 20% mark have been incredibly robust for Asian Paints. And I think the same will play out again this time. What I think helps an Asian Paints and a Pidilite in such circumstances is the smaller players, not only do they not have the pricing power, not only do the smaller players in adhesives or paint not have the pricing power, they also don't have the ability to deal with the inventory risks that this sort of raw material price volatility poses. So the damage that will be done by the Ukraine crisis to the smaller players in adhesives, in paint, I think will be immense, and that further consolidates the position of the market leader. So we've been, as I said, we've been buying Asian Paints fairly enthusiastically through the correction that the stock went through. And as you are alluding to, history shows time and time again that the impact of crude is a pass-through, both when crude is going up and when crude is coming down.
Same time last year, the bent of the economy was very different. Inflation was coming back, which was considered healthy. The reopening and normalization of the industry of the economy had started. There was a wage inflation which everybody was enjoying. But the bent of the economy is right now very different. Inflation is a real scare. Margins are coming under pressure. Demand stress is visible. How does investing change? Because last year what you bought was a different set of stocks versus what will work this year would be a different set of stocks because the situation around us has changed.
So I would say that the macro situation actually, Nikunj, this year is better than it was last year. Last year, unfortunately, because of that second wave, the demand piece got wrecked quite comprehensively because of the sheer brutality of the second wave. This year, over the last 6-7 weeks after the first 2 weeks of Jan, where Omicron played a role, from the middle of Jan onwards, it seems to be a pretty resilient demand recovery across sectors, whether it is credit offtake, whether it is demand for discretionary consumption products like jewelry, or say demand for building material products. So all our channel checks suggest a fairly resilient demand environment, which is strengthening by the week as the unlock kicks in. So kids are going back to school, as we were just discussing. We're going back to hotels and back to shopping malls and multiplexes. It also means, unfortunately, more traffic on the streets. But hey, and after 2 years of the lockdown, even seeing traffic on the streets has a little bit of optical pleasure to it. But the main point I'm making is the macro outlook is as clear as it can be. We're in a demand economic recovery with demand outstripping supply, as a result inflationary pressures, as a result interest rate hikes. But this is a very familiar situation for India. These sorts of situations in India inevitably have been accompanied by bull runs.
Saurabh, you gave us one hidden gem, Paushak, and I'm just looking at the share price as well. Currently just mildly soft at 94.79. What are some of these other hidden gem stories that you're working with?
So look, I mean, this whole space around supplying basic industrial chemicals to the pharma companies, to the process chemicals industry, and similarly supplying inputs for the FMCG industry, right? So both of these, I call them pharma ancillaries and FMCG ancillaries. This industry is consolidating, right? In each of these pharma ancillaries and FMCG ancillaries, one or two monopolists are emerging, and we've been trying very hard to identify them, make sure that they're clean, well-run monopolists, and loading up on them. So, for example, another FMCG ancillary, as I call it, would be Fine Organics, right? It's a company which provides emulsifiers to pretty much all the breads and biscuits you and I will be having in India. Similarly, there's a company called Galaxy Surfactants. Their products go inside the lotions and creams and shampoos that we might be using. So we're looking at a couple more. We're building positions in one more FMCG ancillary. And what we find very interesting is the FMCG ancillaries also have the pricing power to take raw material cost inflation and pass it on to the the FMCG, right? So the giant FMCG, whether it be a Unilever or a P&G or a Britannia, and that's in a way the theme of our investing. It's a time when the demand environment is strong, but because there are inflationary pressures, if we can identify companies with pricing power, we'll come out of this smiling.
Those are some interesting names, looking at Fine Organics, Galaxy, Surfactants, as well as Paushak, as that you flagged off. Saurabh, thanks much for taking time out.